To the Real Estate 401k show. I'm your host, Mike Weinstein, alongside Justin Frederick and Ryan Gerdes. You're going to want to text 2025 to 623 AZ Recon. That's 2025 to 623 AZ Recon. All right, boys, we are now knee deep into, maybe ankle deep right now into the new year. And there has just been, 2024 as far as real estate goes was just wild. It was just crazy, unpredictable. I thought, we kind of had an outline for how 2024 was going to go. Definitely didn't work out like I thought. So we're into 2025. Want to get your guys' thoughts on where you see the real estate market going. What are the trends? What are your predictions? And I'll start with the first one. Because I think the biggest topic of all of real estate right now for 2025 is what is going to happen with interest rates. Mm-hmm. Agree or disagree with that?
100% agree.
I feel like I don't. I feel like that's an old topic. I feel like there's a lot of people that were just promised so many things from the feds that they're just like, 100%. You know what? Fuck you. I don't think you guys are going to do shit to our rates.
No. I'm saying that's the number one thing that's on people's minds.
People are still talking about it. I mean, that's the first question.
Right. No. I understand what the question is, or I understand the statement.
I don't think you do.
Okay.
I love it. He's definitely emotional about this subject.
I think that people are tired of thinking about it, and I think that for a lot of people, they're just going to say, "Hey, look." Rather than banking on new rates coming through and instead of having a 6 in front of my rate, I'm going to have a 3 or a 4, that they're like, nope, I'm just going to I'm going to stop the idea of dating the rate. And if it comes along where I don't have to date the rate anymore, then so be it. But I'm going to put myself in a position where if I'm stuck with this rate for the rest of my life, I'm going to do it.
Yeah.
But that being said, I still think that there's going to be opportunity, maybe not this year, maybe not next, but
somewhere in the future
that we're going to have some relaxation on interest rates. When I was hearing all these experts talking about it getting down into the 5s coming Q3 of 2024, I was like, you guys are outside of your minds. And I think that a lot of people went out there anticipating that, started spending a bunch of money, and then unemployment was not really doing much, but inflation was going up, and so rates just said, you know what, we're going to stay right here because you guys are going to pay it. And then they did.
Yeah. Well, then, and I think the lesson on that is, if you're going to buy something today at today's rate, you got to make sure you truly can afford it long term. Mm-hmm. You can't get into it with the assumption of, hey, by the end of the year, rates are going to drop, and then I'll refinance, because they may not.
And here's the real problem, though, is you had all these economists for Fannie Mae, Mortgage Bankers Association, and they were getting tons of publicity through the news, all kinds of articles, and the consumers were banking on it, right, and reading it, and it just and we've been having this since 2022, so we've had 2.5 years of just predictions that haven't come true. And I'm right there with you, Ryan. Like, I think it's bullshit. Like, stop giving me. I don't want to listen to them anymore. I don't want to tell my customers what they're saying, because it's all been inaccurate, and it's kind of misleading, and I hate that. I want to give insightful, educational information.
Give me something with meat on it.
Right.
Yeah.
So I agree with you, Mike. It's if you're getting into something, you're signing a contract on it, and it's a 30-year fixed, you got to anticipate that that's what's going to be. Now, chances are good that most likely you'll be able to refinance it and save some money. And there was 2 awesome points of last year where we saw short-lived interest rate drops, and people were able to jump in and save some money. But there was also people like, oh, I'm waiting for those 5s, and we're like, well, we're seeing that things are going to change, because what we can kind of predict is what's going to happen in the next 30 days based on the reports that are coming out. That's more accurate information based on real-time reports, right? So I think we just got to live within those periods of time.
All right. So I know you guys don't agree with me on this, so I'll give my first prediction, but I'm also going to have I'm gonna have an additional question. So I'm going to defer to you first on this because I want to know over the next 30 days. So my prediction for 2025 is I feel like rates are going to drop enough to where there is going to become somewhat of a quasi buyer's frenzy. I think if rates do drop, if we wake up one day and we see a 5 in front of the rates, I think then we're going to have just multiple offer situation again. I prefer personally for rates to stay where they're at because I don't want another buyer's frenzy when I'm an investor, right? Then my second additional question to that is, have there been any talks or any speculation? Because there are people that think that January 20th, when President-elect Trump takes office, that magically rates are rates are going to drop 2 points because
I've heard it a lot.
because he's and I'm not trying
And
to
everyone's income is going to double.
and gas prices are going to be 99 cents a gallon and so forth, not understanding that things just take time and the president of the United States does not necessarily have that much of an impact on, if any, on mortgage rates. But I know there's a lot of people out there just that are thinking that. So your thoughts on rates, you agree with me, disagree with me that rates are going to drop significantly and we're going to see another buyer frenzy? And then is January 20th going to be the magic day?
Yeah.
Rates are going to be 3.25.
So as far as interest rates go, I mean, again, it really depends on inflation. It's all inflation driven, and all the inflation reports. We had some really good months within 2023.
I could make any prediction in the world if I could throw the word "depends" in front of it.
Yeah,
so
of course.
I'm asking you to commit, pal.
So we made huge strides in 2023 on inflation numbers. Now, what happened was 2024 came in and reports were replacing month reports from 2023 on the year-over-year numbers. And those reports were higher than 2023's numbers. So it shows that inflation is still going up. So I think we're at the end of getting to their target goal of 2%. But this last bit of getting to 2% is going to take us a long time to get it to the 2%. So I'm going to say that I don't feel
When
like
you're talking about inflation numbers,
yeah,
right?
correct. Which interest rates follow. I don't think we're going to get to the point within 2025 that we're really comfortable with where inflation's at. When I say where the Feds are uncomfortable with inflation. Do I think that they're going to still drop the Fed rate? Yeah, because they're easing in. They don't want to hold it off for too long to really damage the economy. So that's why they've been lowering the Fed rate, which banks borrow against. It's not mortgages. So I think that there will be 1, maybe 2 points that are again short-lived that will see a 5 in front of the rate. And do I think that we're going to have pick up in buyers? Absolutely. And I definitely think that the people are going to be pulling the trigger on getting contracts in place or offers in place. But I don't think that we're going to see a consistent lower rate. I think that we're going to live in the rate range of, I'm going to say an average of 6.5 to 6.75 this year, which is even lower than where we're at right now. I mean, right now a par rate is sitting at 7.25 for a conventional loan. So I think that we got some work in front of us, but I do think that this year people are going to be more confident in what's happening. And I think that people are going to transact more this year because they're I think because they're used to what's happening with the rates. I mean, because we've been living in this for 3 years now, 3.5 years on where basically rates have been higher. And then I think that, your question about Trump, I think people, that's also going to add to the confidence of the consumers. And I think that that's also going to help people to transact because they're going to make a move, again, banking on this economy is going to get better. They're trusting in the system a little bit more. And to be honest, I hope that all happens. I hope that we start to see things start to get a little bit more consistent and steady. rather than the wildness of 24, where there was times where things were shut down, and then there was times where it was crazy wild for no apparent reason. So, yeah. Does that answer your questions?
Yeah. Ryan?
So January 20th is not D-Day.
No.
I think that everything that is going to happen this year is going to be gradual.
Regardless of what side of the aisle you're on, regardless of what side of the beach you're on, it's not D-Day.
Yeah, it's not D-Day. There's still going to be plenty of opportunity for our investors out there, and then there's going to be some trials and tribulations for some other people out there as well. I don't ever think that one president or one office is going to be the ultimate solution, and quite frankly, any president has more pressing matters than worrying about residential interest rates. Mm-hmm. The first place that they're going to go is they're going to try to save any and all issues that are going to come in commerce, because commercial real estate is already taking a hit, and it's getting ready to be a bloodbath.
They're
out
getting
there.
their asses handed to them right now.
And so they're going to want to make sure that they're creating opportunity for employment before they're going to make sure that you're satisfied with your interest rate, because they've already done a lot of fail-safe stuff for the past 10, 15 years, ever since the Great Recession, making sure that everyone's full doc loaned on full doc loans. So we don't have a ton of arms out there that are going to adjust. We don't have a bunch of no income, no asset loans out there. Those are high risk loans that we saw massive recession. Those aren't really out there anymore. So I don't think that they're going to give much attention to residential interest rates. I don't think that they're going to do much to try to incentivize home buyers to buy. I do think, though, however, that more sellers are going to put for sale signs out. I think that the sellers that were kind of waiting because they didn't want to sell their 3% interest rate in order to go buy whatever, whether it be to level up or to scale down or whatever they were trying to do, I think that they're going to finally get off the fence because they've realized that, hey, the numbers are the numbers. But I do think that people are going to get a little bit more creative in how they sell their real estate. I do think that there's going to be more people out there that are open to carrying their notes. I do think they're going to be more open to doing wraps. I do think they're going to be more open to just kind of doing some more creative financing that's outside of the norm, what normal people consider whenever they're going to go buy a home. And I think that that's going to help a lot of people make those leaps. And so like on the optimistic side, I think that that's really going to help things out. On the realistic side, though, I don't think that we're going to see anything with anything below a 6 in front of it unless you're buying down your rate. And I mean, aside from FHA and VA, right? Mm-hmm. So we're going to see some of those there. But I do think that people are going to take more advantage of their VA entitlement. But I do agree with you. I do think that we're going to see a little bit more uptick in default. I think that with some of the inflation and some of the unemployment numbers,
well, that was pregame talk. We haven't announced that yet on the official podcast.
Oh. Well, at any rate, go ahead. I'll let you take the floor then, buddy.
Well, no. So one of the other predictions that we talked about, because we have seen, and I think we're going to continue to see credit card debt go through the roof. And I just read an article that, in the state of California, credit card debt is just at record levels, which means that, people are living on borrowed time. Mm-hmm. And so in 2024, we saw an uptick in defaults, meaning people not paying their mortgages anymore. I don't think it's going to be anything like 2007 to 2009. I that's not what I'm predicting, but I am predicting an uptick on that. And I think we're going to see more and more people as they default on their credit cards. Then they're going to start defaulting on their mortgages, going through the foreclosure process and losing their homes, which is it's a sad thing. And I don't wish it on anyone. And that's why when anyone reaches out to us and they're behind on their mortgage payments, we're coming to them with options, and we're trying to help them fix the problem. But not everybody wants to fix the problem. A lot of people just kind of put their head in the sand and just going to ride it out, which I think means then, Ryan, for the investment side of things, and even for homeowners that are looking for even a better deal on a home and willing to put some money into a home to fix it up and so forth. I think there's going to be a tremendous opportunity for buyers who are savvy enough to work with outfits like ours that can help find properties that are in default, and especially for investors.
I agree with that, and I think that a lot of consumer reports are going to look a lot different than they did 3-4 years ago. Like I think that we're going to continue to just get more horizontal. I think this is going to be an even bigger horizontal year for Maricopa County than years in the past. We saw a lot of vertical climbing once they did a lot of stuff downtown, Old Town, downtown Chandler. They're doing a lot of mixed use stuff, which I actually love seeing. I would rather see things get a little bit more vertical. But I don't think that's going to happen. I think that there's a lot of companies that are taking advantage of all the tax havens and all the benefits of moving on the outskirts of town. I think TSMC is going to continue to just flourish. I think that I think Tonopah, Buckeye, and Queen Creek, a lot of those
Santan
Valley, they're going to see a lot more growth. They've been working a lot on infrastructure, so I think that there's going to be a lot of people that are going to take advantage of that. But in terms of default. There's going to be a lot of people that are going to be willing to sacrifice these different amenities that they once thought that they wanted out of their home by saying, you know what, maybe I didn't get the pool, or maybe I didn't get that 5th bedroom, or maybe we didn't quite get our 3,500 square feet. We got 3,000 instead, but we got a hell of a deal on this property because we were to pick it up as a REO through a bank or real estate on foreclosure. So I think that there's going to be a lot of people that are willing to sacrifice that, which in the long run is going to equate to people owning real estate for shorter periods of time. So I think that a lot of these people that are, let's say they're a second-time home buyer, they average living in a property 5 to 7 years. I think that that's going to shift, and I think that those types of homeowners are going to be living in those properties for 3 to 5 on average rather than 5 to 7. So just kind of looking forward, not through just this year, but what the next 5 to 10 years looks like. I think that's what it's going to equate to. But when you look at like the numbers as far as value and as far as volume, I think we're going to look at a pretty darn flat line. I don't think we're going to see a double-digit appreciation number. I think that it's going to be more like closer to a 4 or a 5. Of course, we're going to have some zip codes that are going to do remarkably well, just as they've always done, because they attract good contractors, they attract good jobs, they attract good homeowners, and they usually get pretty stubborn about when they want to sell. They usually hold on to those properties for a good 15, 20 years on average, whereas those ones where they are attracting more first-time home buyers, those are the ones that they're probably not going to see as good of an appreciation as the others.
And Justin, I know you're seeing it on the lending side and the qualifying side. Credit, am I right?
I definitely think that credit card debt's going to continue to go up. We've already seen an uptick in bankruptcies coming through for individuals looking to restart or have just barely started restarting. So we're having to go back through what bankruptcy seasoning looks like for people and set a plan for them to be able to buy a house once their seasoning has been met for bankruptcy. I think that you're going to be right on defaults as well. I think that the number is going to be very slim on what we can see on foreclosures. And this is just my opinion, just because of what we've seen on modifications and what they're doing quickly when it comes to these modifications. And not all banks are the same, or servicers are the same. So the servicers that we are seeing that are reaching out, some of the servicers aren't reaching out at all. So at least from what our clients are telling us. But I definitely feel like we're going to see more of a flat line again with the appreciation, just like Ryan was saying. I think that new builds are definitely have been more attractive, and they're helping to keep that line flat for resales, because the new builds are so attractive. Even if you're giving a really good deal to a client, man, these new builds with the interest rates that they're offering, and it's keeping those resale numbers lower, I feel like.
I want to to Justin's point, Ryan, these loan modifications and just if our listeners aren't familiar with it, when you become 30, 60 days late on your mortgage payments, oftentimes the bank will work with you to modify the loan and so forth. For me, and I'm not saying it's 100% of the case, but I think it's a temporary fix. I think somebody who gets behind on their payments, has racked up credit card debt, needs to do a loan mod with their bank. The mortgage payment is not the underlying issue. It's either the income, the spending, and the credit card debt. And I think for a lot of these people who successfully negotiated a loan modification, I think are going to be back in the same boat 12 months from now.
Yeah, if they're being irresponsible about how they're posturing their loan modification, then they're just trading one sin for another, and they could quickly find themselves back into the same boat. 3-6 months later. Really, what it boils down to is there's a lot of people that just need either a good swift kick in the ass and just saying, "Hey, look, like you don't get to go on 5 vacations a year. You get to go on 1. You don't get to go buy that brand new vehicle. You get to use the one that you've been driving for the past 2 years." And just kind of saying, "Hey, look, go boil down your financials and rebuild and work out a budget that is actually realistic." And then pad it, because I do think we are going to continue to see inflation. I don't think gas. So let's say gas prices go down to $2, right? Your water bill or your electric bill is going to go up by $2. Something's going to happen, right? Like the government's never in it to just take in less money. They're consistently getting more and more in the hole, whether it's on a county basis, state basis, or federal basis. So you're going to see it somewhere. So just keep that in mind. And I don't care what side of the aisle you're on. If you're politically motivated about your prospects for this year, stop it. Somewhere, somehow, they're going to compensate for wherever you're saving, and that's okay. I mean, people need to make a living, and prices of things just never go down. Somewhere it's going to go up, and that's where, and that's why that padding is so important. And we've been extremely conservative on how we budget for things. And like, for instance, we have an investment property right now we've just been getting our ass kicked on, but it doesn't matter because we built so much budget into it to make sure that should this happen, that there's not going to really be any blood.
Right.
And so whenever you're making any type of financial decision, you're filling out something that requires your social security number and your signature, you need to really think twice and make sure that you're not adding to your overall exposure.
All right. Well, 2025 is, I think, going to be a stellar year for real estate. And if you want to have a conversation with us and pick our brains and help build that strategy, or you just think we're a bunch of jackasses and you want to let us know, go ahead and text the word 2025 or the numbers 2025 to 623-AZ-RECON. That's 2025 to 623-AZ-RECON. Before we wrap up, I want to make sure you guys didn't have any additional predictions or thoughts on what we're doing in 2025 when it comes down to real estate.
I think I've already been long-winded enough.
Yeah, I feel good.
All righty. Again, text the numbers 2025 to 623-AZ-RECON.